Bill Ackman's journey from ambitious investor to activist. Bill Ackman has recently made headlines by short-selling $1 billion worth of Herbalife stock, betting on the company's eventual demise. He believes that pyramid schemes like Herbalife are destined to collapse, benefiting only those at the top. Following this announcement, Herbalife stock dropped by 14.6%. This isn't Ackman's first public attack on the company. He is known as an activist investor with a relentless ambition to challenge corporate America and make billions. From a young age, Ackman displayed a strong entrepreneurial spirit. He started a cart waxing business to earn his own money and was always confident. Some might say arrogant. Born into a wealthy family, his grandfather built a successful real estate business in the early 1920s. By the time Ackman was born, his father Larry had taken the family business to new heights, making millions of dollars a year. Growing up in such an environment instilled in him the values of hard work and ambition. After achieving a near-perfect SAT score, Ackman was accepted to Harvard University. Like many young men from successful families, his father expected him to eventually take over the family business. However, after spending 2 years working for his dad, Ackman realized he wanted to create his own business empire, one that would surpass his father's achievements. His journey took a significant turn when he met Warren Buffett, the most celebrated investor in the world. Ackman admired Buffett's ability to transform Berkshire Hathaway from near bankruptcy into a $700 billion behemoth. Meeting Buffett inspired Ackman to pursue investing seriously. He believed that Buffett's long track record of compounding returns at over 20% was unmatched, and aspired to replicate that success. The 1990s were turbulent for the US economy, recovering slowly from the Black Monday crash. However, this stagnation allowed hedge funds to thrive as opportunistic investors sought profits where others could not. With $40,000 in savings, Ackman began looking for investment opportunities. One of Ackman's first significant investments came from an area where he had considerable knowledge: real estate. Recognizing that even if the company went under, its properties would still hold significant value, Ackman bought shares at a low price. After Alexander's emerged from bankruptcy, its stock price surged from $8 to $21 per share, almost tripling Ackman's original investment. This success led him to co-found Gotham Partners with classmate Dave Berkowitz in 1992. They focused on undervalued stocks and generated impressive returns, achieving a 20% return in their first year. Ackman's talent for rallying support became evident as he raised additional funds for Gotham Partners and began adopting an activist investor approach similar to Buffett's early days. One notable investment opportunity arose with Rockefeller Center during the early 1990s when the real estate market was struggling. The stock price of Rockefeller properties collapsed due to high debt levels and financial stress from bankruptcy proceedings. As an expert in real estate, Ackman recognized that the REIT was significantly undervalued and began purchasing shares aggressively. Partnering with businessman Joseph Steinberg, they acquired 7% of Rockefeller properties and attempted a takeover. Although they were outbid by David Rockefeller and Goldman Sachs, Ackman's investment paid off well. Gotham finished 1995 with a remarkable 39% return. By the late 1990s, Gotham Partners grew rapidly to $500 million in assets under management. However, despite his success, Ackman faced challenges ahead. Ackman's downfall began when he heavily invested in Gotham Golf, a group controlling numerous golf courses across the country, believing their value would continue rising. Unfortunately, as real estate values declined, so did his investments. Instead of cutting his losses, he doubled down on his positions. Ackman's strategy mirrored Buffett's concentrated investment approach, but failed to account for the differences between their investment structures. Unlike Berkshire Hathaway, which can hold investments long-term without liquidity concerns, hedge funds face quarterly redemption pressures from investors wanting their money back. As losses mounted with Gotham Gulf and investors began withdrawing their funds, Ackman sought creative solutions to save his fund. In search of liquidity, Ackman turned to Prepaid Legal Services, a multi-level marketing company selling legal services, believing it was undervalued despite widespread skepticism about its legitimacy as a pyramid scheme. To boost its stock price and regain investor confidence, he released public letters praising the company's potential. However, legal troubles ensued when MBIA sued him for market manipulation related to his prepaid legal services investment. As more investors fled due to uncertainty and losses continued mounting at Gotham Partners, Ackman found himself desperate for help. In this challenging environment, he reached out to Carl Icahn, a notorious corporate raider known for aggressive tactics, to form a partnership. The collaboration was fraught with tension, but ultimately led to a court ruling favoring Ackman after he sued Icahn over an agreement concerning Howard Realty shares. Despite winning $9 million from Icahn in court, a significant victory, Ackman's reputation remained tarnished after Gotham Partners collapsed. Undeterred by setbacks, Ackman quickly launched Pershing Square Capital Management, with $50 million in new capital, focused on activist investing in more liquid public companies. His strategy involved identifying struggling businesses and advocating for changes that could enhance shareholder value. One notable success came when Pershing Square took a 9.9% stake in Wendy's in July 2005. After launching a campaign urging Wendy's to spin off Tim Hortons, the company agreed just weeks later, causing its stock price to rise significantly. By 2010, Pershing Square had become a major player on Wall Street, with $10 billion in assets under management, due largely to Ackman's concentrated investment strategy. Bill Ackman's journey illustrates both the volatility of investing and the importance of adaptability within financial markets. His experiences emphasize that success can be fleeting. Learning from both triumphs and failures is crucial for long-term growth. As an activist investor committed to identifying undervalued companies and advocating for change within them, Ackman's story serves as an example of resilience amid adversity, a reminder that navigating challenges is vital for achieving lasting success in an ever-evolving financial landscape.